Hello everyone, Dan Longman here with Priority Lending. I hope you had a fantastic April. Can't believe the month is already coming to a close. A couple things I wanted to share with you that occurred this month in the mortgage industry that'll definitely have an impact on us all. Number one, the purchase contract. As most of you are aware, FAR rolled out a new purchase contract early this month, and there's a couple changes in regards to the financing portion of that contract. The biggest change that occurred here is regarding the buyer's escrow deposit. There's always a loan approval period on any contract. It used to be called loan commitment. Now they've substituted that with loan approval. The buyer's deposit now, once the loan approval expires, their deposit becomes hard. So that means that their deposit is now in jeopardy if they can't close on time or close at all after that loan approval period expires. Prior to that, a bank or lender could issue a denial letter up until usually a couple days before closing, and the buyer was entitled to get a refund of their escrow deposit. Now that has gone away. So this contract tends to favor sellers a little bit in that area. So very important that your buyer is not only aware of this, but also important that they are pre-approved properly. Make sure that their bank or lender is vetting them and gathers all their income documents, reviews everything. Not only can issue them a pre-approval letter, but once it goes under contract, that they can not only approve that buyer, but close them on time. So very important. Keep a lookout for that for your buyers and for yourself. Number two, Fannie Mae just recently announced some changes that's definitely going to have a positive impact on our borrowers. Biggest change they came out was regarding student loans. When qualifying a borrower before, when it came to student loans, we had to take 1% of the outstanding balance that they owed and use that payment in their ratios, in their qualifying ratios. Now, if the credit report shows a minimum payment, we can actually use that in lieu of the 1% balance. So that'll definitely help out. That should help people qualify in general or qualify for a higher amount. They're also allowing people that are refinancing and paying off student loans. There used to be a price hit to that on a cash out refinance. They're actually waiving that when they're using the consolidation of a student loan. So that will definitely help people in the refinance arena. And then lastly, a non-mortgage debt, so a car loan, a credit card, things like that. If somebody else is paying that debt on behalf of our borrower or client, as long as they've been paying that debt for 12 months, we can actually show that payment history and then not have to count that against our client. So that'll help out as too. Before, if it was a joint account, you'd still have to ding that person or count the liability against them. But now if they have a parent, a relative, or someone that is paying that debt and we can show proof of it over a 12-month period, we no longer have to count it. So these changes will definitely help out as far as getting people to qualify. I think the overall theme here is that Fannie Mae is definitely loosening their guidelines, which is always a good thing. So anyway, just wanted to share those couple things with you. As always, if you have any questions, feel free to reach out to us, and I hope you have a fantastic May. Look forward to talking to you all soon. Thank you.